Hey everyone, welcome back to This Is Not Financial Advice. I've been seeking out and getting some feedback on ways to improve the channel as well as the quality of the videos, and gotten some feedback about having the videos be a little bit shorter, using some different terminology, things of that nature. So I'm going to give it a try here while we look at Apple stock. So, one of the most popular companies or stocks in the country and the history of the world. Ask you to go ahead and hit that like button, subscribe if you haven't already, and we're just going to jump right into it. So, taking a look at Apple, recently described as the best company we've ever invested in so many words, by Warren Buffett. So, we're here on Qualtrum. Um, I pay for Qualtrum. I'm not affiliated with it. I'm going to leave a link in the description below. But we're going to look at some of the metrics for Apple. And basically, if you only take one thing away from this video, I would look at some of these metrics as well as some of these different financial results. And when you can sort of see some of the numbers and some of the patterns, just use this video and use these numbers as a tool basically to compare every other company against. And it's going to make it really hard for companies to stand up to, because this is just basically one of the most well run and profitable businesses in the world. So I'm highlighting the metrics that we need to be taking a look at, for the most part. Let's start over on the right hand side. So they pay a little bit over 0.5% for a dividend yield, and their payout ratio is 16%, which means of their bottom line, only 16% of that is going to break off shareholders a piece of the action. Usually that number is safe until it gets to about 40 or 50%. So what this means is if you buy Apple stock today, it's very likely that your dividends are going to increase a really good amount over the next couple decades. So there's going to be a lot of growth of that dividend. Buying a share today, it doesn't mean that you'll get 0.5% today, but in 10 or 20 years, it's going to be a lot more than that, is basically my guess. So additionally, we can see they've got $63 billion in cash and $100 billion in debt. That's a lot, but the ratio is actually pretty attractive. I'm sure they have a really good credit rating, probably better than the US government, better than me, obviously. So, Apple free cash flow yield is 3.6%. It basically just means that, after they pay for the labor and the materials and they market stuff and ship stuff and sell stuff, out of every $100, 3.61% of it is that bottom line. So they process $100, they're getting almost $4 of that as just sheer profit. And then the last metric we need to look at is their market cap. So, I'll touch on this in another video for the sake of brevity, but this is a $2.74 trillion market cap company, which means that it's a mega cap, which means that it's, in a class of its own, along with companies like Microsoft. There's only probably, to my knowledge, about maybe 10 or so mega cap companies in the world. There may have been about 15 or 20 tops at one point, closer to 15 or a dozen that had qualified as mega cap. But right now, I think mega caps there's probably 10 or less of them. And so Apple's in that big boy club. All right, so let's take a look at revenue. Pretty interesting here, but it goes up and to the right. It's going up and to the right pretty strongly. We like that. Over the last 10 years, its average growth rate of 9.7%. But it even seems like it's been accelerating and then maybe slowing. So in the last 5 years, it's jumped up to 11.5%. The last 2 years is almost 20% growth. But then the last individual year was a slowdown to only 7.8% on one of the biggest companies in the world. And that's still a lot. So these are the numbers we're going to be basing the assumptions off when I give you guys, a fair value estimate of what this stock might be worth. Reminder, like and subscribe to the video. We're going to keep it moving. So free cash flow, What I'll say about this is I'm selecting this button here, um, and I'm using free cash flow to measure how profitable they are. Basically, free cash flow, as opposed to something you may have heard or seen somewhere like EBITDA, it's basically just the truest and most accurate representation of truly how profitable is this company on the bottom line. They can't fudge the numbers, and this filter here makes it even more so, the accurate data. So their average bottom line of profit over the last 5 years is somewhere around like $75 billion a year in bottom line profit. That's a lot. It's going up and to the right. So again, remember, compare any other company you see to this, and you'll always be disappointed. What else do we need to look at? Keep this high level for you. Let's look at shares outstanding. So they're buying back shares, and they have been for at least the last 10 years, like a lot. So basically, the reason we like buying back shares is if you have an 18-inch pizza, and you have a slice of it, that 18-inch pizza, if you were hungry, would you want it to be cut into 8 slices or would you want it to be cut into 4? So when a company buys back shares, you essentially they're lessening the number of slices in that same 20-inch pizza. And so if you're holding one in your hand, it becomes proportionally bigger. I hope that makes sense. I think it does. So, and they're buying back shares. That's great. There's some nuance to when and how companies buy back shares, but I'm going to leave that out for right now. So how profitable are they? When we give them dollars by investing, or when they take on debt by selling people bonds, basically, it seems like the average over the last 5 years is, yeah, like 30% return on capital employed, a median. That's a lot. As high as 60%. That is a highly profitable company. Give Apple money, they're going to turn into a lot more money. It's a good stock to be with. Looking just at their historical price to earnings multiple, price to earnings or EPS is kind of a crappy term that companies use when they don't want to talk about free cash flow. They can basically flub those numbers a lot more when you hear earnings or EPS. That's why we talk about cash flow more often, but it's just kind of a quick at a glance way to value a company. So they are trading at a historical premium right now at a 25 PE, but I don't think it's too much for this quality of a business necessarily. Okay, that's it. Insiders are selling. It could just be because they want to buy their second yacht. Now we're going to get into the value of the company. Stock is $179. Two quick things fast. It's down almost 10% because of some hubbub in China. I'm not worried about it. I'm a long time holder, and I'm be a buyer of this weakness. Spoiler alert. And then just for fun, here's what I own in Apple. So I've got about $1,200 in Apple, and I'm up about 16% on it. So no big deal. All right. So we looked at all that. Now we're going to get over to this machine on the left, the discount cash flow calculator. So there's the average free cash flow of the last 5 years, $73 billion. So each year they have $73 billion of bottom line cash flow. And on top of that, they're sitting on a cool $63 million of just straight cash. $63 billion of straight cash. They have $100 billion of debt. No one's worried about that. Shares outstanding, they're buying them back. Looks like I think 16.3 billion. So I put in, remember we looked at, and you can zoom back and pause and rewatch the portion where we talked about the growth, trying to make this a quicker video, to encourage people to like this video and subscribe to the channel. But we put in assumptions of growth over the next 5 years of 10%. Seems pretty reasonable. Growth over years 6, 7, 8, 9, and 10 of 7.5%. And then a terminal growth rate of 4%. Usually this should be with inflation, but Apple can raise their prices and people are still going to buy it. They also sell software as a service. They can people are hooked on Apple and they can charge whatever they want. So I gave them a little boost, a little benefit for the doubt. Price of the stock 178. Estimated value of the stock 110. So let's talk about this. Um, Investing is both an art and a science. Okay. Um, this company may always trade at a premium to what its fair value is. This is an exceptionally well run company. So if you knowing that your money is over a long period of time is fairly safe with Apple, say you were comfortable with getting only 7.5% a year, the company would be slightly undervalued right now. Okay, so it's not an exact science, um, but I guess I'll leave you guys with this. It says at the regular discount rate, the discount rate is, long story short, it's about how much money you want to make each year on the stock. It's the way that this math science magic works. So $178 stock, I'm saying it's worth around 110, but it also might always trade a little bit higher. And so I think that when we talk about what a mean reversion means for Apple, when things get really bad, this stock went as low as 130 at the very bottom of the 22 bear market, which was ending in January of this year. And so the company was even worth less then because they've produced a lot more economic activity and value since then. So, you know, stock is 178. This little machine says it's worth 110. But I did say that I'm buying it at this price. Um, but a great way to get exposure to it is to buy a broad-based index fund like VOO. Basically, it just puts the biggest stocks first, and so a big chunk of that would be Apple. If you want to, Apple a day keeps the doctor away. Do what you want with this information, but you can get exposure to it either through an ETF like VOO or others, or in my case, I'm buying the stock, and I also have exposure to it through my work 401k. But that's pretty much it. Like and subscribe on the way out. If there's any other companies you'd like for me to take a look at, break down for you, just leave it in the comment below, and I will see you next time. Thanks a whole lot. Bye.